Just think about it. The baby boomers alone hold more than 54% of all the stocks on the stock market. And these people are either retiring or already retired. Are you going to be waiting to see 2026 or 2027 potential recession, drawdown of the stock market? If you started investing 30, 40 years ago, you're up, 7,000%. Would you be waiting to see what the market has as a surprise for you? I don't think so. The problem here is that a lot of people speculating that these guys might be selling. And I understand this is a very large speculation. Why? Because if you look the historic data, how these people actually vest their retirement funds or retirement accounts is usually on 4 to 6% on an annual basis. They're taking profits in these ranges, but like I said, this time around is different. Why? Because the market is at all times high, and there is a major shift in the economy coming from the AI sector, which means a lot of other stocks that these people have been holding throughout the last 20, 30 years may not see another high, right? We saw this with many companies that have been doing well, have been doing all right, have been paying dividends, some of which. But if you realistically see that some of these companies have no connection with the AI, they have no upside, they have no partnerships, and they cannot be left behind in this trend, well, you really want to prepare yourself for potential $25 trillion worth of securities and value being at some points maybe gradually dumped on the market. Because again, remember, these people, they don't have the time to recoup the losses, the potential losses, if the market actually sees a major correction. And why would you risk, right? If you're like, 60, 70 years old, why would you risk? The second positive flip side on this speculation is that if these people sell, there's going to be a buy side. There's going to be a lot of these asset managers, maybe BlackRock, maybe Vanguard. There will be a lot of Wall Street investment firms who will jump to buy the dip. They're not going to be buy the first dip. They want to make sure that all of the retirees are finished selling. Then when the market establishes potential new bottom, they will be start buying. And this is the moment where most likely we're going to see a lot of retail investors. So it's not going to be as bad as you can imagine, right? 54% drawback. But remember, the usual strategy in the past was when you taking 4 to 5% annually from your retirement by selling stocks, you shift to something that is less volatile. Also, has appreciation upside, maybe smaller one, but also has much less risk. The problem here is that they really don't see anything that is, alternative where they're gonna go. Because sure, they could sell this 54% worth of stocks, but they're not gonna sit in cash. If you watch my previous video where I explained $2 million today will be worth $750,000 in 40 years, or it might be even less than 40 years. So these guys, if they sell, they're not gonna be sitting in cash. They're gonna be buying something else. And this is where the unlock might be coming for real estate, because also looking at the historic data, a lot of these people will not be spending this money. They want to make sure that they leave some of this wealth for inheritance, and this is why there is a speculation that they might actually shift a lot of this liquidity towards real estate, which again might be good news for the real estate market, which this year I would say has struggled big time. So it is a good thing to keep in mind. Millennials hold around 8% of the stocks, which is very small, and I would say not going to have any impact on the market. There is a big investment firms or retirement funds that could scoop this 8% if really there is some correlation of sell-off or exiting the market. But for this 54%, I think it's a bigger deal. Especially considering that there will be probably some changes next year on taxes. President Trump is really working towards different things that improve, or at least offset the economic hardship. So bear this in mind, okay? Expect something that a lot of people don't really know. They don't really expect this to happen, but like I said, you need to put yourself in the shoes of these people. So you will be able, unbiased to think about, right? If you are 60s, mid 60s, 70s, and you have a portfolio, your 401k, Roth IRA, whatever, personal 401k, would you be waiting to see the surprise that is coming next year? The market might make new highs. Sure, it's possible. We have OpenAI IPO expected. We have SpaceX IPO expected. Many things could happen. But the idea is this going to be just a few runners rally, or this will push the whole market? First of all, if in 2026 we have an economy, specifically the US economy booming, and if we have the GDP breaks the estimates, we're going to have gold not only sell off, there is a potential crashing gold. Because if the economy is booming, there is something called opportunity cost. All the big investors, being individual, institutional, or even governments who currently hold gold, they're missing so much on gains and returns not being invested on the stock market, on the crypto market. So there will be a major capital allocation if the US economy is booming. This is your number one catalyst. The first report for the GDP, you have to pay very close attention to the estimates. The second important catalyst is the interest rate rise. This is kind of confusing. A lot of people might be thinking that if the interest rates go up again, or we didn't see more rate cuts from the Federal Reserve, well, this might actually be beneficial for the gold prices, right? That's not really the case, because if the interest rate remain high here in the US, well, then this simply means that the gold and the interest in gold might remain elevated here in the States, but the interest outside of the US might not be as high. Because remember, if the interest rates are high, if the gold prices are high, this means that we're having a weaker dollar, which is very beneficial for all the other countries who are essentially importing goods from the US, right? Because the dollar is cheap, the export is very cheap. This is why there is a universal law where it is always a principle in the US economy where you don't allow the dollar to become so strong, because this would disrupt import-export mechanisms that are in place. So this is second very, very important catalyst you want to pay very close attention. And third one is, of course, the dollar. So far, we already mentioned that the prices of the precious metals, the gold, the silver, even the palladium, even after the crash, have been elevated not because they're more valuable, not because there is more demand for it, but simply because the value of the dollar has gone lower for the money printer. So this means that the rebalancing, if the rebalancing reappears, which means the dollar regain its value, this means that it will pushes automatically all the precious metals on the lower end of the equation. Also, more powerful dollar, like we mentioned, will be equivalent again to stronger GDP, which brings us back again to point number one, the first important catalyst. So everything is kind of interconnected. It might be a little hard to follow up if you didn't study this. It's cool if you didn't have like economic or finance degree education, but I believe it's very simple if you just at least read the news, follow the news, every single economic report that comes in, you can read. They're not necessarily 100% accurate. They don't really tell you exact numbers. They always give you a ballpark, which is most likely not accurate, but they give you the directional trade. They give you the direction in which things are going, right? They cannot give you completely opposite prediction or estimates when things are going in the opposite direction. So again, a lot of people are hoping for very strong 2026 for precious metals, which indicates a major disruption, which means that risk of assets will be crashing if the gold continues the rally, which means bad year for crypto. better for the stock market, which also means better for dollar. And yet, if you have a continuation of the depreciation of the dollar, imagine every other currency around the world, what kind of struggle they will have. And just today, China also announced that they will suspend exports of silver. And China is the biggest producer of silver. What is this even telling you? They're trying to hedge against the evaluation of their own currency. Because, like I mentioned, if there is a bad news for the normal currencies and they see the depreciation of either money printer or we having a debalancing of the national currencies, they're gonna look for something that will hold the value of their country. And this is why we're seeing with China, right? They are going to suspend the export of silver, which is again not a big deal.